Hey, welcome to our channel. I'm Doug, the Simple Investor. Drip or not to drip? Let's find out. YieldMax ULTY, probably one of the most popular funds out there. But the question I started asking is, should we be dripping this, reinvesting all of our dividends? Should we be taking it out as cash? Or should we try something unique that I've been playing with, is a 50-50 hybrid system? Well, we're going to find out today and give you guys all the information. But before I do, I'm asking you, can you please hit the subscribe button, hit the bell notification, don't be afraid to, find out more of the videos we're going to be putting out here, all on the Simple Investor by Doug channel. So let's get into today's video is drip or not to drip. And this is going to be the ULTY Dividend Strategy Analysis for drip or no drip. Well, this came to me with a real scenario is I wanted to build a portfolio for my kids. And the first thing I thought about is putting so much money into the fund. And then do I give them income? Do I allow it to grow bigger? What's the best overall strategy to give something special to my kids? So we decided and sat down and said, let's figure this out. Which way is the best way of doing it? Hey, notice to all viewers, past performance does not guarantee future results. This is really for educational and entertainment purposes only. If you need real financial advice, always contact a financial advisor to make your financial decisions. So first off, understanding ULTY. We've done our research on this when the primary goal of ULTY, it's known as a high yield exchange trade program. It's a fund that just generates big dollars, but has a lot of capital appreciation. So it's really designed for income generation rather than capital appreciation. So this is distinguished by its dividends being paid out on a weekly basis. So I liked the idea that it was going to be a weekly payer. I like that it's generating income, but I wasn't real excited about the capital appreciation loss that we were seeing. So the mechanism that they use is the income generating by ULTY stems from a strategic use of covered call and put strategies on highly volatile underlying stocks. By employing these option strategies, ULTY aims to collect the premiums which they send out as distributions to shareholders. So I like the way they do it. I understand covered calls. I understand the put strategies. So I like what they're doing. But then you get into that volatility, the inherent volatility due to the investment strategy involving volatile stocks and options. ULT exhibits both share price and weekly dividend amounts that are subject to market conditions. So I've watched this over time, the share price movements from, initially when I'm started into this thing at $6.37 down to $5.23. And the weekly dividend payments have varied between 8 and 11 cents per share. So it was very wild, like rough waters in the sea, just bouncing around. So I didn't know which way to do it. So the three strategies that I tested was the dividend reinvestment approach, 100% drip, which is all the money, all the income goes right back into buying more shares. The hybrid system of 50-50, and then a program of zero drip at all. So I just wonder which one is probably going to be the best across the board. So let's set up the analysis. What I virtually did is I took $50,000 of investment money, put it into the fund on March 13th of 2025. The initial stock purchase that I made was $6.37 per share, which allowed me to buy 7,850 shares. So the first strategy using 100% drip, which was I'm going to take everything every week. I'm going to take that money and I'm going to reinvest it back into it. So what I was able to do was take the 7,850 shares and get a final count of 11,905. My portfolio value went from $50,000 to $65,085. So I was excited. I'm like $15,000 gain. This was phenomenal. 30% total return. and I had no money coming out because it was all going back into building the shares, building the portfolio, and went that way with it. So full dip yields the highest total wealth through compounding, maximizing shares accumulation, and benefiting from the compounding returns. So I was right off the bat, I'm like, okay, we got something here. We're going to do probably 100% drip. But let's try the other strategy. Strategy number two, which is a 50% cash income and a 50% reimbursement growth, which is what the original idea I had for this, thought this would be the best way of doing it. So we were able to take and go from 7,850 shares up to 9,715 shares. The portfolio grew only $2,949, so it went from 50,000 to 52,949, which gave me a 27.76% return because I was able to pull out $10,930. My idea of this is you're still growing shares, you're still growing your portfolio, but you're also taking and be able to pay bills with $10,930 from a $50,000 investment. Not too shabby. So we start with strategy number three, and that's a zero drip. This is the income focused program. Now, when I sat down and did this, the shares stayed the same, which I expect. 7,850 shares is what I started with, is what I ended with. But this is the one that got me. My portfolio went from $50,000 down to $42,782 because of the price drop of the shares. So I wasn't real pleased with that one. Now, it says I have a 24.95% total return because I took $19,695 out to pay bills and do different things with it. So income versus capital with the zero dripping, I take out $19,695. My final value of the fund is down to $42,782. And like I said, I'm not the smartest guy in the room. I turned around and said, now the 19,000 that I took out, 7,000 of it goes back, is out of my own pocket. It's my own money I put into it. So I really was not pleased with the 0% drip on this type of a fund. I hear a lot of people talking about, oh, I've retired on ULTY, I'm collecting my money. But are you really doing it? Because you're really just taking money out of your portfolio. And how long can we exist by taking money out of a portfolio? So I did the results. I put the side-by-side comparison of the funds and said this: 100% drip, zero amount of cash income. My fund went up to 65,000. I was excited about that with a 30% return. The 50/50 drip gave me cash, $10,930. It gave me some increase by about $2,949 for a total 27.76% total return. And then on the zero drip, taking all the money out, I'm taking some of my own personal money and putting it with it because I'm down to $42,000 in final value. So it's really a 24.95%, but some of that's my own money. So hands down, it gives me a real good comparison and answer of exactly what each one of the systems does. So let me give you the key takeaways. Full drip maximizes your wealth by buying on at the end of every week, buying more shares with those dividends. If the price goes down, you're buying even more shares. If the price goes up, you're going to buy less shares. But overall, you got your best maximum wealth building all done by full drip. Now, the balanced drip provides a very stable system, which I was very pleased with. 50% drip strategy offers the significant cash income of $10,930 from a $50,000 initial investment, while allowing a moderate portfolio growth. Yes, it's a strong return of 27.76, and my growth went up about $2,000. So I was pleased with the balanced approach. I got cash to go spend and do things with, plus it's slowly growing. But the no drip, which maximizes my income, I was not pleased in any way, shape, or form because you're dealing with the volatility of the price of the stock. Now, I know I've talked to other people about this, and they said, well, if you're buying in a $6 range, you're probably paying too much for a fund. But you don't know when to buy at the rock bottom. Will it go lower? When will it go higher? We don't know. So to me, the saving grace across the board comes down to this. I believe the number one way to do this is if you want to just build wealth, do the full drip. If you got 5, 10, 15 years, just full drip it and just let it roll. You know, as they always say, just drip it and rip it, let it roll. But the other one that I think is the very, very interesting one that we came up with was the balanced drip approach. It gave me very stable growth with a very stable income, and I was happy onto it both ways. So, conclusion, basically comes down to is aligning with your strategy with your goals. The best dividend strategy is not a universal solution. It's not it's not the only way to be. So if you aren't focused on growth, then you're a 100% dripper. If you're a balanced, focused person, probably exactly what I'm looking for is you're a balanced guy with a 50% drip, 50% income. And then if you want income, you're going to be a zero drip and you're going to take all the money out and you probably don't even care about your portfolio value because as the price of the shares go up, your value will come back. As your price goes down, it'll get even smaller. But you have to understand the trade-offs of each one of these strategies is critical for the information and the decision making. Hey, I'm Doug, the Simple Investor. Hope you guys liked this. Don't be afraid to hit the like button. Please hit the subscribe button. We're trying to get to a respectable 1,000 people watching our videos. And if you have any comments, leave them down below. Try to answer you. Try to give you any insight. This is the first video of many to come. So hopefully we'll see you next time.